It's Guy with the Altman brothers here in San Diego, and here is our real estate market report. As you know, the market has changed. The number one thing we're seeing is that the bid-ask spread is so wide that it's just hard to get deals done. What I mean by this is that buyers feel the market is so soft that their expectation of where a deal should get done has completely bottomed out relative to where sellers think a deal should get done. The result is that the spread between seller and buyer expectations is making it very difficult to get a deal done right now. The primary reason for this is that interest rates have moved from roughly 3% to about 6%. That change translates to an approximate 50% reduction in affordability. That is to say that a traditional 30-year fixed mortgage today is 50% more expensive than what it was 3 months ago. A lot of people are moving towards adjustable rate mortgages, which can push rates down and recapture some of that purchasing power. But we've also seen a large segment of the buyer pool completely taken out of the market. And even though mortgage rates are pushing demand down, inventory levels are still low, which are keeping the prices relatively high. We are also seeing a lot of homeowners who are planning on selling their homes are choosing not to because they don't want to trade their current low interest rate for a potentially doubled interest rate on a new home. So less homes are coming to market, which is depleting the inventory and keeping the prices propped up. So the big question is, when are rates going to stop rising? Well, the most likely answer is when inflation stops rising and starts a downward tilt. And the driving force behind that will be when the Fed has sufficiently addressed inflation concerns. So if you're an investment property owner, you have to decide whether you're going to be prepared to hold and wait for the next cycle of about 7 to 10 years, or do you want to take advantage of the fact that you're very much at the top right now and cash out? In terms of the real estate market future, well, there's a downward pressure in the form of the reduced buyer pool, but there's also been an oversaturation of buyers in the past couple of years, meaning that the market can actually afford to lose a lot of buyers and still keep the prices in the right place. At the same time, there's also the reality that mortgages are about 50% more expensive to the borrower than they were just a short time ago. But overall, we do expect to see the gap between seller and buyer expectations begin to normalize in the next 2 to 3 months or so. So this analysis is obviously fairly myopic and isn't even addressing the amount of wealth that's been recently wiped out in the stock market. Anyhow, thanks for watching, and I look forward to seeing you soon.